Hello everyone. My name is Mark Roberts, owner of Affinity Asset Management. Welcome to this week's edition of Community Cafe. My partners, Glenn Stockton of Stockton & Stern Law Firm and Chris Toman with First Option Bank, they have today off. So today it's just me, and our topic is, do you want more money and less taxes in retirement? The answer is, of course we do. Today is going to be fast-paced, and I'm going to teach you Tax Law 101. It's going to be easy, but I'm going to show you some simple strategies that can help reduce future income taxes. Thus, you have more money to spend in retirement time. So the younger you are, and the sooner that you do this, the bigger, the better the tax savings will be. So currently, our U.S. debt is about $26 trillion with two stimulus packages that we've already done earlier this year, with a third one around the corner. We expect the U.S. debt to go higher, and following that will be income taxes going up. So get out some paper and a pen. Make some notes. If not, you may just want to replay this video a little bit later. Do me a favor, please, as we're sharing this live on zoom.com as well as Facebook Live. Please share this with your friends. So click share on your Facebook and share this with them. And then also follow us on our Facebook group called Community Cafe. So go to Community Cafe and click follow so that we can give you some updates on that as well. Let's start off first with tell you about a little bit about a card game. Let's say I'm here in the office and I'm playing some cards with Stacy in the office. And I've never played this card game before in my life, and Stacy's going to teach me how to play. So who's likely to win, me or Stacy? Stacy should win. And the reason why she should win is because she knows the rules, and therefore she should beat me. But now let's change that a little bit, and let's assume that we played this card game 10, 15 times. We played it for an hour, 2, 3 hours. Now who's likely to win? I say it's more balanced, more 50-50. She should win, I should win. We both know the rules, but I still say Stacy has the advantage. The reason why Stacy has the advantage is because she knows the rules and she's been playing it a lot longer, that she's figured out strategies to stay inside the rules to beat me. That's what I'm going to do here today, is I'm going to teach you the strategies, very simple tax law strategies on how to reduce taxes. If you understand basic tax law, you can understand really simple tax strategies. All right, so let's hop into this. One of my favorite quotes from Judge Leonard Hand: there are two systems of taxation in our country, one for the informed and one for the uninformed. We all have the same tax codes. There's lots of tax information out there, but clearly we're not all maybe doing the same thing because of lack of information. So let's first start by understanding why this is important. What I'm going to talk about is you have to understand what we call the 72 rule. Okay, the 72 rule. It used to be called the 7.5 rule. President Trump signed a bill called the Secure Act at the end of 2019, that starting in 2020, when we're age 72 and older, every year for the rest of our life, we have to start taking withdrawals from our retirement accounts, like those IRAs and 401ks. There's only two things we need to know to determine the required minimum distribution. Number one is, how old are you and how much money do you have in those kind of retirement accounts? Those two things determine the formula. If you don't follow that formula and take that withdrawal and pay taxes on that withdrawal, you get hit with a 50% penalty. They make this penalty be so large because it's encouraging us, it's forcing us to want to take these withdrawals, whether we want the money, need the money or not. They want us to take the withdrawals because they want us to pay taxes. Now keep in mind, this is retirement accounts like IRAs and 401ks and 403bs and TSAs, those kind of retirement accounts that most of us have had money in those kind of accounts for 10, 20, 30, 40 years. And that money's never been taxed. This is the IRS's way of saying, hey, before you die, I want to force you to start taking withdrawals because I want to force you to start paying taxes on this money. So I want to show you how this works. When you get here to age 72, you're going to be required to take a withdrawal. And every year it goes up. The formula goes up because you're getting older and typically the balance of your money is going up. So it goes up. By the time you're 82, right here, it is now doubled. It's twice the amount that it was at 72. By the time you're 92, that requirement has now tripled in size. So let's say hypothetically, by the time I'm 72 years old, I have $1 million saved in retirement accounts. And let's just use a very simple formula of 4%. So at 72, I have $1 million. At 4%, I have to withdraw $40,000 that year and pay tax on $40,000. It doesn't matter whether I need that money or not. I could be working part-time or full-time, spouse working full-time or part-time, pension, Social Security, other investment, rental properties, you name it. The IRS doesn't care about those other things. It's the fact that I'm 72 or older and I have those kind of retirement accounts. I got to withdraw $40,000. If I don't withdraw that $40,000, then I get hit with a 50% penalty, meaning I lose $20,000 in a penalty. So what happens if I take $30,000 out? I'm required to do 40. The $30,000 that I do take out, I'm going to pay tax on the $30,000. The $10,000 that I didn't take out that I was supposed to, I'm losing $5,000 in a penalty. 50% penalty on every dollar that you were supposed to withdraw but don't. Now you can withdraw more than 40, you'll pay more taxes, but there's only a penalty if you withdraw less than that formula, less than that $40,000. So by the time I'm 82, my 40,000s now have grown to about $80,000 a year. By the time I'm 92, it's now grown to be triple the size, about $120,000 a year. Pretty close to doubling, pretty close to tripling. And this formula is designed to go up and up for the rest of our life. Therefore, it's causing us to pay more and more taxes for the rest of our life. These are forced taxes. Now, not only does this cause us to pay more taxes on these withdrawals, but it causes our overall tax bracket to go up, causing us to pay higher taxes at a higher tax rate. 2, it also causes our Social Security tax bracket to go up. And 3, it causes our Medicare premiums to go up because our Medicare premiums is based on an income level. And if our forced income is required to go up starting at 72 and older, that's going to cause our Medicare premiums to go up. If this 72 rule didn't exist, then there'd be a lot of other ways that we'd be talking about keeping money saved in IRAs and 401ks and those sort of things for the rest of your life. But because this rule exists, it plays a major role in causing us a lot more taxes later down the road. So today I want to teach you how you can plan ahead, pay a little tax now, pay a little tax next year, pay a little tax next year. These little taxes, even if you add them all up, it's going to be far less than the huge amount of tax savings that this is going to create by doing tax strategies. I'm going to teach you how to do Roth conversion, Roth IRA conversions. Not a Roth IRA contribution, a Roth conversion. But I'll talk about that in a few minutes. All right, so let's first start on this by looking at the foundation of probably the last 20 years of my 24-year career of me teaching tax law. So for those of you who are taking notes, this is what I'm going to ask you to do, please. Draw 3 circles or draw 3 buckets. Okay, draw it on a piece of paper. And I want you to label the left bucket tax deferred. I want you to label the middle bucket taxable, and I want you to label the right bucket tax-free. All of our money, your money, my money, all of our money comes in these 3 buckets. So tax deferred means we get taxed later, taxable means we get taxed right now, and tax-free means tax never. Now that sounds attractive, tax never. So what I'm going to do with this page is I'm going to walk you through examples that come under each of these buckets, and then I'm going to walk through pros and cons. And you'll clearly see they have their own differences, and they both have pros and cons. But when you start to understand the pros and cons, and you start to understand tax law, then you can start figuring out strategies. Strategies to stay within inside the rules, or in this case, stay within inside the laws. And your whole goal here is, I want to pay less taxes in my life. Trust me, you're going to pay taxes. I'm just going to show you how to pay a lot less taxes by doing these things. These are rules that everybody can do. All right, so in your 3 buckets, and you wrote those 3 down on a piece of paper, what I want you to do is underneath the buckets, I want you to think about you and your spouse where you have money. Anything I have listed here, you don't have to write everything down. Only write it under the buckets, but only write down what you have. So if you have a 401k, write 401k. If you have an IRA, maybe you added to an IRA, or maybe you took an old 401k from a past job and rolled it over to an IRA, write down IRA. Maybe you have a pension, or you or your spouse have a pension. Social Security, most of us have Social Security. I want you to write down everything that you have in this bucket. Now, there's other examples that come in this bucket, but I'm just going to give you like the most common ones. So there's some examples of that. Now let's talk about pros and cons of the left bucket. Left bucket tax deferred. Let's talk about the positives first. The positive is I get a tax deduction. So a tax deduction means I have a job, I make $50,000 a year at my work, I put $5,000 into my 401k at work. I'm not being taxed on $50,000 of income, I'm being taxed on $45,000 of income. So that $5,000 is not taxed. That's called a tax deduction. Number 2 is I get free money from my employer. A lot of 401ks are matched by the employer. They add money to it on our behalf. Employers add money to pensions if you happen to have a pension. And employers are also adding to part of our Social Security as well. So that's free money from the employer. And the third advantage with the left bucket is you have money growing 5, 10, 15, 20, 30 years in this bucket, growing and growing and growing. You've added to it and you've added to it, and it's never been taxed. So the third advantage is tax deferral. So tax deductions, free money from the employer, and tax deferral. It's been growing without being taxed. Tax deferred is kind of a technical way of saying it. I think a simpler way of saying it is it's tax delayed. You're going to pay the tax. It's just going to be delayed until later. So that's the advantage of this bucket. What's the disadvantage of this bucket? The disadvantage of this bucket is I have a 59.5 rule, I have a 72 rule, and then I have to pay taxes on my withdrawals. At any age I take a withdrawal, I got to pay taxes. Now the 59.5 rule, we've all been under the age of 59.5, so we should know this rule. It's a 10% penalty. 10% penalty. What that means is I take a withdrawal from the left bucket, like from a 401k or an IRA or something, and I'm under 59 and a half. Well, first I have to pay taxes, but two is because I'm under 59 and a half, I have an IRS penalty. I got to pay a 10% penalty on top of the taxes just to get my money out. So it's a slap on the back of the wrist that the IRS doesn't want you touching this money until you're at least 59 and a half or older. So if you have to take a withdrawal under 59 and a half, you have taxes and a 10% penalty. So that's the 59 and a half rule. The 72 rule is the 50% penalty that I just showed you on that previous slide. That's the big rule. God willing, we're all going to live past the age of 72, or at least our spouses will, and we're going to have this rule kicking in. And again, if this rule didn't exist, we'd be doing very different planning, but this rule has been around for a very, very long time. It's called required minimum distribution, RMD. So we're forced to take withdrawals whether we want it or not, because we're going to be forced to pay taxes on this money whether we like it or not. It causes our Social Security tax bracket to go up, it causes our Medicare premiums to go up. That 72 rule just kind of sucks. But this bucket's got pros and cons. Now the middle bucket, I'm going to give it to you kind of like the left bucket. I'm going to give you the common examples, but there are other examples that are out there. Bank accounts, money market, CDs, stocks, bonds, and mutual funds. Now where you see listed here stocks, bonds, and mutual funds, what I'm referring to is the kind of stocks, bonds, and mutual funds that's not in the left bucket, IRAs and 401ks. It's not in the right bucket, Roth IRAs or Roth 401ks. These are regular stocks, bonds, and mutual funds that you've invested into that at the end of every year, that investment company sends you a 1099 form that you must pay tax because those accounts grew. So stocks, bonds, and mutual funds, you earn interest, dividends, or capital gains, you're going to get a 1099 that you owe tax on that money. Okay, so there's other examples, but these are your most common ones. So let's say, and again, I want you to do the same thing, that you write down the ones that you have. Well, we all got bank accounts because we all got checkings and savings. Maybe we have some stocks, bonds, and mutual funds. You know, we have things like this. So I'm going to write this down. So what I'm circling is where I have my money. So pros and cons of this bucket. Positive is no 59 and a half rule, no 72 rule. I like not having rules on my money. You like not having rules on money. So that means if I'm under 59 and a half, I can take a withdrawal. If I'm over 72, I can let it grow. This middle bucket has no rules. I can put money in whenever I want, take money out whenever I want. In essence, there's no IRS rules with this bucket of money. So that's the advantage, no rules. The disadvantage of this bucket is I'm getting taxed every year. When my money makes money, when my accounts grow, interest, dividends, or capital gains, I gotta pay taxes on it, and I get a 1099 that I have to report with my tax return. So the disadvantage is I gotta pay taxes every year, okay? That's the middle bucket. Again, there are some examples, other examples of these are most common. Now, in these two buckets are flip-flop. In the left bucket, I pay taxes when I take a withdrawal. I don't pay taxes when it grows. The middle bucket, I pay tax when it grows, not when I withdraw it. See how they're different? So they're flip-flop of each other. One bucket's got both rules. The other bucket has neither rule. But what these two buckets have in common is tax, and more tax in retirement time. The middle bucket's taxable all the time. The left bucket has the 72 rule, forcing us to take withdrawals, forcing us to pay taxes. Okay, so that's why we understand those two buckets the way that we do. The right bucket is what we call the tax-free bucket. Tax-free means tax never. And I mentioned in the left bucket and the middle bucket that there's other examples, but I'm just kind of picking the common ones. In the right bucket, that's all that we got. Roth 401ks, Roth IRAs, municipal bonds, and cash value life insurance. So it says certain types of life insurance. What I'm referring to is life insurance that has like a savings account wrapped around it called a cash value account, like a whole life policy or a universal style policy. If your life insurance is term life insurance, then it doesn't apply here. So again, like the other two buckets, only write down what you have. If you have a Roth 401k, if you have a Roth IRA, if you got municipal bonds, you got these things, write it down. So let's just pretend I'm not going to circle anything over here. Okay, most people don't have money over here, so I'm just going to leave that blank. Now, that's our examples. What are pros and cons? Let's hit the negatives first. The negative is I have a 59 and a half rule, and that 59 and a half rule is just like the 59 and a half rule over here, works the same way. If I take a withdrawal out of the right bucket and I'm under the age of 59 and a half, I'm going to get hit with a 10% penalty. It's tax-free because it's out of the tax-free bucket. The left bucket, I'd have to pay taxes. The right bucket, no taxes, but I got to pay a 10% penalty. So the 59 and a half rule works the same. That's one disadvantage. The biggest disadvantage of the right bucket is lack of knowledge. So I have a book that I wrote 5 years ago, and whenever I autograph it and give it to somebody, I always write in the front cover of the book, the biggest fear people have today is they don't know what they don't know. So the reason why people don't have a lot of money or any money in the right bucket is because they don't know the rules, or what they do know, They think they're disqualified because they don't know all the other rules that do qualify them. So the biggest disadvantage of the right bucket is lack of knowledge. I'm teaching you things that pretty much everybody in America can take advantage of one way or the other of getting money into this right bucket. So I'm going to teach you a little bit about that today. So disadvantage is the 59.5 rule. The biggest disadvantage is lack of knowledge of how to get money into this bucket. Mark, my financial advisor, didn't tell me this. Mark, my CPA, didn't tell me this. Mark, my HR department in my company didn't tell me this. So please understand, I don't want you to go out and beat up your CPA by not telling you about this stuff. We're paying our accountants and our CPAs to do our tax return and to give us tax advice. But the tax advice they typically give us is on this year and last year. We don't typically sit down with our CPA and talk about what can I do now that's going to save me taxes for the next 10, 15, 20 years. That's just not how CPAs are wired. They only work on current tax codes because they have no idea what future tax codes are. Well, we don't either, but we're planners. They're tactical thinkers. They're doing what they have to right then and there. We're strategic thinkers planning for the future. So I don't want you to get upset with your CPA for not teaching you this stuff, but at the same time, I don't want to get you upset with your financial advisor either, because our industry in the financial services industry, we're promoted and we're talked to about not talking about tax strategies to our clients because we're not tax people, we're financial people. We should sell product and get paid selling product. We should get paid managing product, but we shouldn't talk about taxes. But you know what? Taxes, Social Security, pensions, all these things are intertwined with our investment products, all for retirement. It's all overlapping. So there's very, very few financial advisors out there that have a really good knowledge base on not only just investing, but tax strategies. And that's what I'm trying to teach you here today is tax strategies. All right, so the advantages of this bucket. How about this? 4 advantages. Number 1, tax-free growth, tax-free withdrawals, tax-free to my beneficiaries, and no 72 rule. You see that? No 72 rule. There are 2 buckets here that do not have the 72 rule. Only one has the 72 rule, and that's the left bucket. So tax-free growth, tax-free withdrawals, tax-free to my beneficiaries, and no 72 rules. Wouldn't you agree that those are pretty good advantages? Okay, now that you understand that, no tax, again, no tax. These 3 buckets all are different. They have examples, there are pros and cons. Ideally, we'd probably love to have all of our money in the right bucket because we like all the reasons for the right bucket, but we don't know how to do that. And most of our money is going to be tied up in the left bucket and middle bucket. So let me ask you this. So as you've written out your 3 buckets, you've written out examples on these 3 buckets, and this is good if you write this stuff out because it's going to help you see this. Now look at how you circled things underneath it. Look at what you filled out under the buckets. On top of the bucket, you see a white box with a % sign. All right, so I'm not asking you how much money do you have in each bucket. Here's the question that needs to be asked. Think of retirement, and if you're retired today, where's my paychecks? Where's my income coming from right now being retired? If you're not retired and still working but planning to retire, down the road, where's my income going to come from? Where am I saving money? Where do I plan to take income from and down the road? So what I want you to do is put a % in the buckets. What % of your retirement income is going to come out of the left bucket? What % of your retirement income is going to come out of the middle bucket? And what % of your retirement income is going to come out of the right bucket? Now in this example here, I don't have anything circled in the right bucket, so I'm going to put 0. And I'm going to say maybe, I'm guessing 20% here, 80% here. I know that you probably don't have this memorized, and you probably don't. You don't need to have this memorized, but I want you to fill out the buckets. I want you to write down examples under the buckets, and then I want you to use your best guess to how to fill out the top part. Your best guess will get you close enough. Your best guess will prove what I'm trying to say here easier to you, because when you see it applied to your numbers and your situation, it's so much easier to understand it. So I'm thinking in retirement time down the road, 20% of my retirement livelihood is going to be paid to me out of my accounts in the middle bucket. 80% of my income is going to be paid to me out of the left bucket. So I'm clearly having the left bucket. And if I asked you how you filled yours out, and I said, which 2 buckets do you have are the 2 biggest buckets? I bet you would say the left and the middle bucket, just like I've illustrated here. If I asked you which one of the 3 buckets is the largest bucket that you have, you would say the left bucket like I have here. I did an example that I find pretty much most people, 99% of the people that I come across look like this. They're heaviest in the left bucket, but they got a fair amount in the middle bucket and very little in the right bucket or none at all. And our goal is to get money in that right bucket. I'm going to teach you how to take money out of this bucket here. And when we do take money out, we have to pay taxes, the IRS, but we're going to move it over here. That's our goal. That is called a Roth IRA conversion. I'll explain that in just a couple minutes. Roth IRA conversion. I'm going to teach you how to take a little money out of this pocket here, pay a little tax, move it over here to this pocket here, and as it sits in that pocket and grows, that pocket's not going to be taxed. Down the road, you want to take money out of that pocket. It's tax-free. When you die, this entire pocket goes to your kids. And this pocket over here doesn't have any 72 rules. So our goal is to get money in that right bucket. So this is my way of teaching you tax law. So this is not meant to be a sales pitch or anything like that. So I'm not trying to sell a product. So let me just use examples of products. So let's pick on Amazon. Amazon's a big stock. We've all heard of Amazon. Most people are shopping with Amazon these days, trying to avoid going out into stores. So let's say you want to buy some Amazon stock, and I'm going to sell you some Amazon stock. Can I sell you Amazon stock in the left bucket? Sure, I can put it in 401ks, I can put it in IRAs, I can put it in annuities, I can put it in SEPs, I can put it in 403bs. I typically can get you Amazon stock in a lot of different places in that left bucket. Can I sell you some Amazon stock in the middle bucket? Sure, right there, Amazon stock there, and there's even Amazon stock in mutual funds too. Can I sell you some Amazon stock in the right bucket? Yes, I can get it in Roth 401ks, I can get it in Roth IRAs. I can sell you Amazon stock in all three buckets, okay? The buckets, I want to be clear on this, the buckets is not about making money or losing money. The buckets is my way to teach you tax law. Basic tax law, you can figure out strategies to minimize taxes. We're not going to beat the IRS. We're just trying to minimize what we pay to the IRS. You're going to pay taxes. I'm just going to show you how to pay a lot less in taxes. So you have Amazon, let's say, in all three buckets. If Amazon's doing really, really good right now, and let's say Amazon's up 20%, great. If I have Amazon in the left bucket, I'm going to make 20%, but that 20% is taxed later. If I have Amazon in the middle bucket, it makes 20%, great. I make 20%, but I'm getting taxed this year. And if I have Amazon in the right bucket, yay, I made 20%, but it's never taxed ever again. That 20% is tax-free. Isn't that great? So let's say Amazon's having a bad year. Amazon's down 10%. If I own Amazon in the left bucket, I'm going to lose 10%. If I own Amazon in the middle bucket, I'm going to lose 10%. Own Amazon in the right bucket, I'm going to lose 10%. Amazon is my product. Stocks, bonds, mutual funds, money markets, CDs, annuities, these are products. These products make us money, lose us money. How you own those products inside the buckets will dictate the rules and the taxes. So the most of you that are watching this video already have the lion's share of your money, the bulk of your money in the left and middle bucket, with the left bucket being the biggest bucket. So let's change the scenario. So instead of me selling you Amazon, let's say you already own Amazon and you own Amazon in the left bucket. That's the majority of your money. The thing is, I can take some of your Amazon out of the left bucket, take it out, pay low tax, and put the Amazon in the middle bucket without ever selling, without ever getting on the market, keeping my Amazon stock. I don't have to sell the stock to go from left bucket to middle bucket. I just got to pay the tax on however much Amazon I take out of the left bucket. So if I have $100,000 of Amazon and I'm going to take $10,000 of it out of the left bucket and put that $10,000 in the middle bucket, I just have to pay tax on the $10,000, not the full $100,000. Same thing applies as I can take that same $10,000, $15,000, $20,000, whatever, out of Amazon in the left bucket, and I can move it over to the right bucket too, without ever selling my stock. I'm going to take it out, I'm going to pay my tax, move it to the right bucket. Now we can do tax withholding by selling a little bit of Amazon stock to pay the tax, or we can pay the tax from an outside source. We have options. And based on the makeup of your assets and in your situation, will kind of dictate to us kind of how you want to handle that and how you want to pay those taxes. Again, you're going to pay taxes. The 72 rule exists. You're going to pay taxes. It's going to be very rapid. It's going to go up a lot in your older ages of life. It's going to cause your taxes to go up. It's going to cause your Social Security tax bracket to go up, cause your Medicare premiums to go up. I'm going to have you start at a younger age, doing a little bit by little bit by little bit now, without going into higher brackets. And if we do that, not only do we prevent major tax problems down the road, but we don't have Medicare premiums going up. We don't have Social Security taxes going up. And overall, it's a massive tax savings in our lifetime. Huge. Okay. So we can actually get out of Amazon stock out of the one bucket and move the Amazon stock to any one of the other two buckets, preferably the right bucket. We don't want to take Amazon really out of the left bucket and put it in the middle bucket. You can, but if we're going to take it out of the left bucket, I'd rather put it into the right bucket so that it stays Amazon, but it's going to be tax-free from now on in that right bucket. You can also do that when it comes to changing product. I want to get out of Amazon and I want to go over here and put it into a Vanguard mutual fund. Well, I can sell out of Amazon stock in the left bucket and move it over into a Vanguard mutual fund in the right bucket. I can do that. Again, I'm just paying tax on the money that comes out of the left bucket. And if you notice, the left bucket has the 59.5 rules and the right bucket has the 59.5 rules. So when you go from the left bucket to the right bucket, you can be under 59.5 like I am. I go from left bucket to right bucket, no penalties. Just got to pay the tax. So how much do we do? That's kind of the genius behind people, and then you get technology behind that. Figuring out a strategy that works for you with your timetable, your assets, your income, your goals. how much do we take out this year out of the left bucket, pay a little tax, move to the right bucket. Next year, how much do we take out, pay a little tax, move to the right bucket. And figure out a strategy so that you do just a little bit every year. And what you're doing is you're spreading out that tax from that left bucket over more and more years. You'll spread it out over more years, and you have more and more years to grow your money, compound grow your money tax-free in the right bucket. That's a win-win. So the thing is we're not getting younger. The sooner in life you do this, the better off you're going to be. You're younger, you got more years ahead of you. The sooner you do this, the better. I don't care if you're in your 30s, your 40s, your 50s, your 60s, your 70s. I don't care. You're never too old. You're never too young to do tax saving strategies for yourself. All right. So we're on the subject of Roth IRAs. Let me walk you through this. There's only two ways you and I can put money into a Roth IRA. It's called a contribution and it's called a conversion. Two different rules. So a contribution right here says, here's my rules. Number one, I have to have a job. So if you're retired, you can't do Roth conversions. If you're laid off, you can't do Roth contributions, I'm saying. If you're laid off, you can't do Roth contributions. So number one criteria is I have to have a job to be able to do a Roth contribution. Number two, my job can't be over this amount, single and married, it can't be over this amount. So as long as I have a job and my income is below this, then I'm eligible to save and add to contribute to my Roth IRA, $7,000 for me, $7,000 for my spouse. Now that's for people age 50 and older. If you're under 50 and under, it's just a little bit less. But that's three criteria: job, income limits, and then a dollar amount limit on how much you can do for a contribution in here in contributions. So let's focus on conversions. Do you guys see what the rules are for conversions right here? Conversions are no rules. What does that mean? No job limits. I can have a job, have no job. There's no income limits. I can have a little income, I can have a huge income. No income limits. And then there's no dollar amount limits. If you have $1 million in your IRA and you want to move $1 million over to your Roth IRA and do a conversion of $1 million all at once, I can do it in one fell swoop. Don't recommend it. That's a whole lot of tax to pay in 1 year, but there's no rules. That's what I'm trying to get at. Any dollar amount that we want to convert out of our retirement accounts in the left bucket, move it over to the right bucket, we can do that because there's no job limits, no income limits, no dollar amount limits. So the thing is building a plan and building a strategy for you that allows you to maximize your situation today, minimizing the tax today, but with maximum tax savings in our lifetime. So kind of keep that in mind. So we're back to here. What I'm basically going to try to do is I'm going to try to teach you how to take money out of these types of accounts here, pay the IRS, as little as we can each year on this, and we're going to move it over here into Roth IRAs. That's our goal. Little bit by little bit by little bit every year. Minimize those taxes every year, maximize tax savings for the rest of our life. Now, on a couple of strategy things here, let's pretend here you give me $20 to invest, and I'm going to put $10 into one investment and $10 into the second investment. The first investment, this $10 grew to 15. So how many dollars did you make? I made $5, right? The second $10 I invested went into a different investment. It dropped down to 8. So how much money did you lose? I lost $2. Did I really make $5? Did I really lose $2? No, I didn't make 5. No, I didn't lose 2. When do you make $5? When do you lose $2? When you sell. Everything is based on selling. You don't make a $5 profit until you sell it at 5. You don't lose $2 until you sell it at 2. So if I'm sitting down with a couple and I'm asking them, this is your investments, you've given me $20, one $10 goes to 15, the other $10 drops to 8, and you're retired and you call me up and you want to take a withdrawal from your accountant. Let's say an example, you want me to give you $3 out of your account. Would you prefer I sell and take $3 out of the $15 investment so I can send you the $3 to spend? Or would you prefer I take the $3 out of the $8 investment so I can send that to you to spend? Either way, you're going to get your $3. Would you prefer I take it out of the $15 investment or the $8 investment? I would say 9 times out of 10, people are always telling me to take it from the $8 investment. Why? Because that's my dog. It's my bad investment. It's doing the worst. Leave my $15 investment alone to continue to grow because it's doing really well. So common sense, that makes sense, but in reality, that's the wrong answer. I don't want to lock in a gain. I don't want to lock in a loss. I want to lock in a gain. Okay, so think about it this way. We know the past, right? We can study history. You can just go look at your investment statement. I paid $10 for that investment. Here's the present. I can look at my statement. I can go online and I can see that $10 investment grew to 15. I can see the other $10 investment is dropped to 8. We know the past. We know the present. Those are facts. What we don't know is what? We don't know the future. So is it possible for that $15 investment to still grow? Yes. Can that $15 investment start to go down? Yes. Can the $8 investment still go down? Yes. But now can the $8 investment start to go back up? Yes. We don't know what it's going to do we? Nobody has that crystal ball. But what we know is the past and the present. So if I'm going to take withdrawals out of accounts, I'd rather take a little withdrawal from this. I'm not getting rid of that investment. I'm just taking $3 off that investment to put into another investment or to send to you to spend, because I want to lock in a gain, not lock in a loss. I've always said the number one reason that people blow through their portfolio in retirement time quicker than they want is they're taking their withdrawals from the wrong place at the wrong time. Meaning some lazy investment company, some lazy financial advisor set up the accounts for auto withdrawals. So it's like the 15th of every month, it's going to send you $3,000 on the 15th of every month. Well, if the 15th of the month is a good day in the stock market, the computer's going to go in and sell different investments to generate the $3,000 to send it to your bank. That's good. But if the 15th of the month is a down day in the market, it's not a good day to sell, but the computer doesn't know it. It just knows today's the 15th, so it's going to go in and sell to send you the $3,000. You only want to sell high, you don't want to sell low. And anybody that has a diversified portfolio, some of your investments are growing better than others. Some are up here, some are here, some are down here. We always want to shave a little off of this, a little off this. And we get you withdrawals off your best investments right now. Little this, little this, little this. I'm not getting rid of the investment. I'm just shaving some of the gains off. And as things rebalance and the stock market continues to move, we might adjust where we take those withdrawals from so that we're always trying to maximize this. So the number one way people blow through their retirement, their assets in retirement time, is they take their withdrawals from the wrong places at the wrong time. We want a much more sophisticated approach of, I want to look at it consistently and I want to pick and choose every month where I take those withdrawals from. That's what we want to do. Now, why is that relevant? Because when we're talking about tax strategies and moving money from IRAs to Roth IRAs, and I talked about taking maybe my Amazon stock out of the left bucket and move my Amazon to stock the right bucket. So you have kind of like two options to do a conversion. One is what we call a transfer in kind. I'm going to transfer my Amazon stock from the left bucket to Amazon stock over in the right bucket. Never sold, never out of the market. I still kept my Amazon. I still have my shares. It's still priced at the same thing. I just have to pay tax on the amount I take out of the left bucket, but I can just move my Amazon stock to the right bucket. The other option is I'm going to sell Amazon and buy something else. So I'm going to sell Amazon out of the left bucket, and I'm even going to buy a Vanguard mutual fund or a Fidelity mutual fund or Microsoft stock or whatever you want to buy. We're going to sell out of the left bucket, buy in the right bucket. Now what we're doing is we're doing tax strategies and layering it with some performance-based strategies on top of tax strategies. Again, I'm not wanting to get into that for today. I'm just wanting to teach you how simple this is to look at what you sell, what you don't sell. So another example of this would be, I go into Walmart, I just bought myself a $30 sweater. I'm walking out in the parking lot and I ran into a buddy of mine. Buddy says, oh my gosh, Mark, that's a great looking sweater. Hey, I'll pay you $35 for that sweater. Here you go, man. I'm going to give him that $30 sweater and he's going to pay me 35 bucks for it. Now, what am I going to do with the 35? I'm going to turn around and go right back into that store. I'm going to buy me another $30 sweater. I'm going to pocket the $5 profit. I sold it at a high. Now, change the scenario. I just bought myself a $30 sweater. I'm walking out in the parking lot, run into a buddy. Oh my gosh, Mark, I love that sweater. I'll give you $25 for the sweater. I say, no, thank you. You can go right in the store and buy your own sweater for $30. Because I don't want to sell it to him for 25. I paid 30 for it. I'd sell it to him. I'm going to lock in a loss. So you don't make money, you don't lose money until you sell. And so that is super important on tax saving strategies. Also very important on that. Okay, so the last thing I want to talk to you about real quick here is what I call my $5,000 example. So this will help hit home of the basic simple math of why you want to save on taxes. Now the concept of saving taxes, we all want that, but let me give you a math problem behind it. So let's go through the math here. You say, Mark, when I retire, I need $5,000 of monthly income to live on for me and my spouse. 5,000 net. We need to be able to spend $5,000 a month. So there's 5,000 a month times 12 months. That's $60,000 a year. Now we need to factor in taxes. So I'm just being really simple, using a nice easy tax rate of 25%, meaning I need to withdraw $80,000 from pension, Social Security, IRAs, 401ks, my left bucket, my middle bucket. I need to withdraw $80,000. So after I pay those taxes, I will have $60,000 per year to spend, which is $5,000 per month to spend. Follow me on that? Okay. Now, but I'm saying, well, if we get you to do tax saving strategies and we start incorporating Roth conversions now, again, I don't care if you're retired or you're still working. Tax saving strategies is tax saving strategies. You're never too old. You're never too young to save on tax saving strategies. So I'm going to get you to shift your thinking. Your goal is $5,000 a month. Let's keep your goal at $5,000. You want to spend $5,000, but what I'm going to do is I'm going to get you a $3,000 check and a $2,000 check. This $3,000 check times 12 months is $36,000 a year. Now this chunk of money here is going to come from the left and the middle bucket. Like over here, this is all left and middle bucket money. So I'm going to use the same tax bracket here at 25% as I did here. And you know as well as I do, if your income's lower, it's going to be a lower tax bracket. But I want to keep it very, very simple so you can see the math here. So 25% tax, that means I need to withdraw $48,000 a year. So after I pay my tax, I can spend $36,000 a year, which is the same thing as spending $3,000 a month. Hopefully that math made sense to you. Where's the other $2,000 coming from? 2,000 times 12 is $24,000 a year, no tax. Where can we get 2,000 a month, or where can we get 24,000 every year from tax-free? The right bucket, Roth IRAs, Roth 401ks, municipal bonds, or certain life insurance strategies that you can incorporate. So let's do the math here. Let's add this up. 48,000 from there, 24,000 from there equals $72,000. Now, the biggest fear people have in retirement time is running out of money. My question is are you going to run out of money quicker withdrawing $80,000 to spend $5,000 a month, or are you going to run out of money quicker withdrawing $72,000 to spend the same $5,000 a month? You're going to run out of money quicker over here. And this is the one that you're on track for. If you are heavy in that left bucket, middle bucket, then you are on track for this math problem. We want to get you on track for this math problem by doing Roth conversion strategies. But there's also a hidden nugget here. So over here, I'm going to withdraw $80,000. I'm going to pay tax on $80,000 so I can spend the same $5,000 every month. Over here, I'm going to withdraw $72,000 a year, only pay tax on 48 of it, which is this part right here, only pay tax on 48 to spend the same $5,000 every month. So not only am I having the same lifestyle, the same spendable $5,000 every month, but I'm not having to take as big a withdrawal to get it, and I'm not having to pay nearly as much taxes for it. What that does is that causes it to be drastically beneficial to my portfolio for the entire rest of my life. So hopefully all this made sense. Today was on tax saving strategies. Hopefully I gave you several different nuggets. I would recommend that you talk with your financial advisor. Seek me out if you want to get a second opinion. Always happy to give a second opinion. I ask you, if you wouldn't mind, take this video on Facebook, share it with your friends, share this out with the world, ask your friends to share it. This is a fun video. This is one of the favorite things that I do in my career. So share that with everybody. Go out to our Facebook page called Community Cafe and click to like us and follow us if you would please. That way, every week that we do this every Wednesday at 8 a.m. Typically, it's two of the three of us. Today, it's just me. But it's usually Chris Toman with First Option Bank, Glenn Stockton with Stockton & Stern, or myself. You have a person from a bank, an attorney, and a financial advisor there covering three different areas, talking on these topics. That's not selling anything. So please join us for future Wednesday, 8 a.m., live on Zoom.com, live on Facebook. So if you follow us on Facebook, then you'll be able to follow us there. Thank you so much. I want to wish everybody happy health and safety.